Now, back by popular demand, it's the Lance Roberts Show.
And it is Thursday. It's Friday Eve. And the best part about that, it's Friday Eve before a 3-day weekend. Woohoo! Memorial Day coming up.
Yeah, baby.
Yeah. So you got any plans?
Working.
I know, me too, right? A couple of things. Got to get into today. Michael Leibowitz to join us at 6:30 today. 6:30, right? Yeah, 6:30. To talk a little bit about the Federal Reserve yesterday, they came out with their minutes from their last meeting. The question is now, of course, are they going to raise rates or are they going to cut rates, right? Remember that Donald Trump had come out recently, and along with Vice President, I almost said Biden. Flashback, sorry.
Mike
brain
Pence.
short.
Mike Pence.
I know, Mike Pence. I don't know why I had Biden on the brain. Anyway,
check.
Exactly. So, even Mike Pence had come out talking about wanting the Fed to lower interest rates 1% here and potentially even restart QE. And the reason is there are definite signs of the economy beginning to slow. We've seen thousands of layoffs from companies just recently be announced, more store closing, retail, etc. And a lot of that's very symptomatic of a late-stage economic cycle. It's nothing. And again, when you talk about recession, everybody's like, "Oh my God, recession!" It's no big deal. That's just part of the cycle, right? I mean, every economic phase has a recovery phase, a growth phase, a maturity phase, and then a recession. And that's just what the cycles are. And unfortunately, what we don't do is we don't prepare for the end of the cycle, right? So at the peak of the cycle, when everything's as good as it gets, instead of, storing up some acorns for the winter, we just keep going. And then stuff blows up and then we have a recession, and it's probably worse than it needs to be. But it's just the way that we work. It's interesting when you talk about employment and these type of economic indicators. A lot of headlines right now is like, man, employment's, sub 4%. This is great. The economy's booming. Yeah, that's correct, right? It is. But that's what you see at the peak of an economic cycle, right? You've done all the hiring everybody that's got a job, everybody that wants a job, supposedly, has a job. And of course, that's that doesn't happen at the beginning of an economic cycle. You don't come out of a recession immediately hire everybody, right? It takes time for companies to get acclimated back after a recession, like we had even just a mild recession, right? Companies cut back, they reduce things, they scale back, they lay off workers, they protect their profit margins. And then as the economy begins to recover, they began to get more confident that, this recovery is now going to last, and I can make some commitments to the markets, right? I can go build out some capital, spend some capital expenditures. I can build out some property, plant, and equipment. I can hire some more workers because I can see that right now that the order flows that I've got and the demand for my goods or services is sustainable. And I've got enough demand coming in to warrant hiring an additional individual. That happens, and they become the most confident where? At the end of a cycle when things are booming, right? So it's just important to remember that, as with everything in life, all cycles do end. And it's not a terrible thing that this occurs, because all a recession is basically just a reset of the excesses we build up in the economy. Mike and I have talked previously about why you have a hangover after you drink alcohol. If you could drink alcohol unabated with no hangover, everybody would be an alcoholic. Right? The hangover reminds you of why you need to moderate your drinking. And it's kind of the same thing with the economy as well, is that we get very excited here. And we just wrote a couple of articles. One of the things that we'll talk about here at 6:30 is what the Fed has been taking note of in particular, and that's corporate debt. And of course, corporations have been binging on corporate debt to do stock buybacks, do dividend issuances. Basically, they've been borrowing a lot of money to do everything that is non-productive in the economy, rather than building out capital expenditures, going out and building a new plant, going out and hiring more workers, etc. They've been spending a lot of the money they've been taking in corporate debt to do stock buybacks, issue dividends, etc., and leveraging their balance sheet because of extremely low interest rates. And of course, that has a consequence down the road. Again, we can, as a household, think about it this way. As a household, if interest rates are extremely low, we can borrow a whole lot of money, and it really doesn't affect our payments much. The problem is when we lose our job. So corporations pretty much work the same way ultimately, and that's one of the risks. We've actually got a report on this coming out on Monday on our website, realinvestmentadvice.com, talking specifically about corporate debt. But today, our article is the 10 truths, illustrated truths about money and investing. It's on the website now. Simply go by the website, realinvestmentadvice.com, and get our latest article and blog post that is there. And, of course, our newsletter will be out this weekend, so make sure you subscribe at the website. Just click the subscribe now button right there, and we'll email you our newsletter this weekend that comes out on Saturday. Simply go by the website now, realinvestmentadvice.com. We'll be right back after the break, get into our show, stuff to talk about, and on this Thursday edition of the Lance Roberts Show right here, realinvestmentadvice.com.
Want a longer talk with Lance about your money? Request a personal one-on-one at lancerobertshow.com.